Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings everyone, and welcome to Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, and I'm joined by Hans Albrecht. You can also find him at LaDucTrading.com/Hans. He's our options mentor, educator, and trader in our LaDuc Slack workspace for members. And we come together every week and kind of talk about the market, little sector rotation, and of course, options education, with our picks that we have used to position for this particular market backdrop. We'll talk about what we're respectively sizing up also moving forward. Anyway, it is also a Q&A, live Q&A, so you can ask us anything. Just hit us up in Zoom Q&A, please, and we'll kind of take a look at that as we go along. We had a very sharp bounce this morning, and I have some very strong opinions as to why it happened. So I wanted to kind of go over those first and foremost, and then Hans will kind of get into everything else that's coming up, especially around volatility at the end of January options expiration, the long holiday, which also includes the inauguration on Monday, and then getting into the end of month with all kinds of Treasury activity, including not just FOMC and Bank of Japan, but Besant is also going to be grilled this Thursday. So depending on how he kind of stages his policies around how to fund these fiscal deficits, we could actually do a little alley-oop, which means we had a really strong day today, but we could also unwind that just as strongly. So let me kind of go first and foremost to a post that I put for clients, and it is very, very strong as it relates to, this is not about CPI. So ironically, the title of this was Bounce Before Inauguration, which we came up with, what was it, Monday morning? So obviously we've had the gap down in the election and then the bounce the past Tuesday and Wednesday. Tuesday was quiet, but this morning, many are kind of focused on this teeny tiny little beat in CPI. And I'm going to push back on that strongly, which is to say the detail of the data against this 44-month long trend in above 3% CPI is not the reason that we had this reflexive bounce today. It's a combination of things, and I want to kind of go over those because I think it really does matter. And it also is very focused on an option trade that I recommended for clients yesterday. So first and foremost, we did have the CPI print out. I did a long review pre-market for clients about why it wasn't so much of a beat. And big picture, we still have very strong trend growth and sticky inflation. But the algos react immediately, even off this tiny little beat pre-market. And we ended up gapping exactly above SPX. Was a line in my sand, which basically we get above 59.05, it's bullish. So basically we gapped down below that level on January 10th. And then 5 days later, here we are, we're back above it. The other reason, which is if you watch hedges, it is a little tricky to do this, especially when they come in last minute. But yesterday, there were a lot of ES futures that were being hedged, so they're buying puts, and it ended up yesterday, this was just yesterday, it ended up driving the put call ratio to like 3:1. So this morning when CPI and algo reaction created this kind of unwind in those puts, that was more fuel for the fire in supporting this bounce today. Yes, Monday it was the election gap down. We all know about that. All eyes were on that prize. That was easy, right? Sometimes when we talked literally about this last Wednesday, sometimes the easiest is actually the most profitable because you just know it's coming and everybody else sees that it's coming, and it came. So we gapped down on Monday, we digested on Tuesday, and then today we had the algos and the hedges, but we also had banks beating. So we had this kind of sentiment relief that banks who that announced this morning with their earnings pre-market kind of relieved the market of the worry of their performance. By the way, they're hiking fees and they're making money off of it, as well as consumer spending. And basically that's a tell on the economy. So recession risk, all that jazz, kind of gets pushed away if banks are doing well. They're the lenders, so we kind of need them, and a rosy print. And we can drill into the bank earnings, but that's not our purpose today. It's the combination of factors that come in to cause this volatility suppression and or drop, and that's exactly what we had. Volatility continued to break down below 1929, and we had markets bid up. But I contend, I know this is 5 points, but I contend that the biggest reason for the season is Bank of Japan. So I had mentioned yesterday that the 10-year JGB was percolating higher. It had pushed from 1.1 all the way up to 1.25. And I said, this is going to make the yen and bonds bounce. This was the number one reason I was looking for. And then the yields would come down and dollar would soften. And that combo deal would also support equities, right? And that's exactly what happened. So last night, we had Bank of Japan came in and basically said, hey, UEDA said that they are very seriously considering a rate hike. And this meeting this month, which is the end of January, is live. So that increases the chance, basically the betting market, right? Those who are shorting yen start to cover. And we had a big bounce in yen, which obviously flows over. We got a rate differential that's going on with US and Japan. And that caused a very nice move in bonds. And that was exactly as I warned yesterday. So literally, in my trading room notes, I had put this, which was ignore PPI, ignore CPI. The reason bonds are going to bounce and yields are going to soften is because of yen bouncing, because Bank of Japan is going to pull forward some rate hike talk or action. And that's exactly what happened. So I did have this, and you can also see a TLT February, $85 call, $85 put, bull risk reversal. So selling the put, buying the call for scratch. It wasn't really scratch, it was like a nickel. Well, that's $1.85 right today. So it was extremely good timing to put that on, but it wasn't so lucky. I actually was giving this time because I said CPI or Trump or peace, which by the way, we also got the announcement this afternoon, Hamas, a hostage deal, very likely, et cetera, which also helps soften dollar and yields. And of course, the yen bounce. So the macro reasons are much bigger than the CPI teeny tiny little adjustment that they made. And this is why I wanted to kind of point that out, because last but not least, this was the reason I gave yesterday, reason number 5. So I've given you the CPI algos. The banks did great. Bank of Japan is already intonating a rate hike. And then of course the hedges had to unwind. This was the 5th reason. I had posted this yesterday for clients and basically said, hey, this is my dollar yield ratio. This is part of my intermarket wonkiness. I call it my secret sauce. And if this rolls over, this is going to pop up. And it literally popped right here. So it literally popped here and we've been moving higher. I should have put a little trend line here. Anyway, the point is this today, I will show you, is right here. Look at this. Look at that. Head and shoulders dumped right back down. And this was taken earlier, obviously, about this morning, 10 o'clock. We're pushing into this kind of 59.75 SPX territory. I wrote down some other things like 596 for SPY. We already hit 517 for the Qs. Long story short, this was a lot of factors, but mostly the yen and the bonds bouncing, causing yields and dollar to fall. And that TLT bull risk reversal was one way to manifest a bounce with time. That was a February OPEX dated bull risk reversal that went from 5 cents to 185. So that worked. Now where to? But before we get there, okay, Hans, where to? Because we just had a very strong bounce, and all of those factors that I just talked about, in particular, the hedges unwinding, they're going to be done. And the big other issue that I saw this morning and did talk about as well before I even knew, hold on, is this. Well, in the trading room this morning, without knowing, this morning, I said, this is a breadth day of size. It looks like a 90% plus, which means many issues were green. And sometimes when you can see just practically everything green, but VIX is red, then you know you're having a robust bounce. So then Walter Demir put out this, yep, it was a 91.73% breadth burst, right? So in other words, it's 90% up day. Let's just call it that. Now, technically speaking, and I said this in my trading room this morning, this is great. This is fabulous. But within 1 week's time, we will see a 90% down day. That's just textbook. That's just what happens when the market does this type of short covering rally of short duration. It will retest another 90% down day. Question is when? All right, so show us what you got and talk to us about where we go from here, Hans, because that's a little bit trickier. I'm giving the hard stuff to you, I know, but we really do have weekend risk, long holiday, Inauguration, and then Trump. And we don't know what the heck is going to come out of his mouth or what policies he's going to roll out.
Well, I think that was an amazing rundown, Samantha. And I noticed we got a couple questions in here. Somebody was saying something, made a nice comment about your amazing energy level and how do you bottle that up and sell it? Because you're going to make a fortune. But also, what are your expectations for this year? And I'm sure that's not a short answer for you. So that we might need. Okay,
let's do short term and then we'll pull out in time.
Okay, so I think the market's been sort of grappling with this obviously this concern of rising rates, whatever the reasons may be. That's something obviously equities are going to have trouble with in general, and so we've seen this move back into the mag stocks. We can see this contribution being very, very concentrated in sort of the balance sheet heroes that we talk about, some of the higher quality names, and the rest of the market's really been struggling. So I think this was a bit of a sigh of relief of sorts for markets that were starting to even worry. We're starting to hear that talk that maybe we'll get a rate hike at some point, and I think that started to make people a little bit nervous because the market wants its punch bowl nice and spiked, and that is the complete opposite, right? That is like being the designated driver. Suddenly when you get rate hikes, you are the designated driver. No, nobody wants to be the designated driver, right?
No. I am the mom in the friends group. That's me.
Okay. So I think, as I always say, the market's male. It can focus on one thing, and so it sort of had these blinders on, thinking, oh my goodness, what's happened since August here? We've gone from we're going to get these rate cuts and we're going to have a big giant party in 2025 to whoops-a-daisy, Powell doesn't really know what the heck he's doing. That's kind of becoming clear. And so we're back in this sort of nervous Nelly type environment here, and I think you were starting to see quite so almost max bearishness a little bit. I mean, of course things could get worse than they did over the last week, but you're starting to see real bearishness out there. Here's some Goldman data versus bulls to the plus side here, bears in control to the downside over here. We start to see a real kind of deterioration of that bullishness. And of course, it's a bit like one of those contrarian things. As traders, we watch these sorts of things as, when things are a little too bulled up, this Goldman Sachs sentiment indicator way up here in November and December, and it just kind of faded throughout the rest of the year. And in January, really kind of dropped down below the 1.0 level, which is, sort of the extra stretched positioning, right? It could get a little bit less bullish, of course. And we started to see some heavy shorting of from hedge funds. I've been reading about that lately, and I just came across this chart today, which sort of shows you this sort of excluding index products. Hedge funds in particular really starting to short out there. And I think you just got this sort of reflexive bounce today. We needed a reason to kind of bounce up. And as we talk about, we always like to talk a little bit about the gamma environment. So if you look at that gamma environment, which hopefully the listeners are starting to get used to a little bit, us throwing out these crazy terms like gamma positioning and accelerants and decelerants. Well, we're sort of anywhere below 59.75. We're in this very red area. And all you really need to know is red means caution. It means the potential accelerant of movement. And so gamma doesn't cause problems on its own. But if you get a reason to sort of start that snowball down the hill, what the negative gamma environment will do is it will tend to accelerate that. Because, if a dealer is short a bunch of out of the money puts, it's getting dinged twice. It's getting hurt because of delta. These things are starting to pick up delta. It has to sell into that sell-off. So you're exacerbating the move because you have big entities actually having to sell into a sell-off. Plus the implied volatility is rising. And that's where Vanna actually comes into play, which is that next crazy derivative that you don't hear much about, Greek that you don't hear much about. That must have been
triggered big time today.
That triggers well. And it does trigger the other way as well, and so this accelerant is very much a fixture of markets for us these days. Structurally, the dealers tend to be short out of the money puts because people buy them to hedge. And the JPM caller trade's an example. What does it do? It sells calls and it buys downside put spreads. So dealers tend to be short puts and they tend to be long a whole bunch of calls up here. So the Vanna, all these Greek effects tend to push things around a little bit. To the upside, Vanna can actually have people it can have the dealers sort of step back a little. The deltas drop, and without getting too deep into into it, the market can basically get into this environment where the movement to the upside gets exacerbated. So we tend to think of gamma being a very bad thing to the downside because, of course, people don't want stocks to go down. But it can happen. It can accelerate things to the upside, and that's kind of what we saw today. We needed a reason, and here we go. Now you pointed out a very good level there, that sort of 59.70, 59.75 level, which I think is very important because I've been maintaining over the last couple of weeks that if we can, this is a big if, but if we can get above 60.25, 60.50, what you're going to get is a less negative gamma environment. You're going to get up into here, which isn't massively long gamma, but what you're going to get is a replenishing of dealer coffers. People are going to start hammering out cover calls. They're going to do what they always do when markets start to head up strongly. People sell out calls, especially with the VIX elevated. People are going to try to generate that extra yield via call selling, covered calls. They're going to be selling options.
What was the level again? I'm showing this is SPX on a 2-hour because I had just shown the same chart with the dollar yield ratio, and I want to see what was that level again. You said 60, 50, basically?
I would say sort of that 60, 50, 60, 55 level. If you sort of look at this is kind of a nice flip. We can almost think of this as kind of a gamma flip. So below 59.24, you're kind of in trouble. Then you're sort of neither here nor there up to about 6,000. But then above 6,000, you get into what I called before when we were up there. I said it's kind of almost like a silo of comfort, a sort of a welcoming area where you have this kind of support from market makers who are now they're able to buy on the way down, they're able to sell on the way up, and that just clamps down on volatility. So I feel that we're not out of the woods, although I do have to say, and I hope you disagree with me because I always want to learn something from you, but I feel like if we're down here, we have this risk of movement.
Where's here? Down here? What do you mean?
Down here, like 5900s, 5800s in particular. But if we just got PPI out of the way, which was who cares? CPI out of the way, which was a small issue. Okay. But do we have any big data coming up? Because sometimes all we have to do is sort of look to the horizon and go, well, if there's nothing for us to worry about, then there is the potential for us to grind into the 6,000 plus level. And then it's kind of a new game, I think. It's a kind of a whole new ball game for us as option traders.
So here on the short duration, since I'm showing a 2-hour chart, since I had just kind of put this up here, right? I'm looking at this going, we all know, we talked about it. What are we going to do after the election? I literally said, what are we going to do after this is the name of the webinar, a bounce into inauguration. So we hit the election. This was the gap up, right? The Trump bump, little thump. Anyway, we did clear it and then jumped here. And then literally, you can't see it right here. It's a little nerve-wracking, but I'm going to show it as best I can. This is now a huge gap. So today we gapped above this gap, 59.05. We will go fill that. That's not a question in my mind. It's just when. It's not if. So we're already pushing up into this trend line. This is obviously taken this morning at 10, so that's not where we are. We actually pushed all the way into 59.60, almost to that 59.75 trend line, first trend line. We have another gap up here at 60.17. At 58. It's not a question of if, just when we'll fill that too. So this whole market right here is crazy Ivan, if anyone remembers Red October, because they do not know how to price in the macro risk or rewards of Trump policies. We are waiting. We also have Bank of Japan, and we also have dollar in yields very bid with a new Treasury Secretary expected to issue longer duration notes and bonds, which is liquidity sucking, versus what Yellen was doing with T-bills, which is liquidity providing. Market does not know what to do. Plus, we've got earnings. I'm less concerned about earnings. I'm much more focused on Trump, which is what literally in my market thoughts yesterday. I'm like, I'm so focused on macro, not earnings, but whatever. Long story short, I think that we're going to do both. We're going to absolutely hit both. We are equidistance. So now the question is, place your bets. Which gap will fill first? The one on the bottom or the one on top? But I do agree with you on this. Once we get and stay above that 60.53, which was the prior JP Morgan collar, right, the top line, we are going to grind our way up into that 61.65, which I believe is the JP Morgan sold call for March 31st. And it's not that far away. It really, that's really really achievable. And so, yes, I believe that we are going to have, in Q1, a very strong chance of going and tagging that 6150. But then I think we're going to have some choppiness in Q2. And then I think we're going to have a mess in the second half, which I've already been on record for like 2 months now. No, 3 months now. So I'm very much expecting weakness Q3 and beyond. Nothing has changed. Like I can't emphasize it enough. I would love to be proven wrong.
Well, I mean, there's, in the end, and sort of what I've been sort of telling community members, I've been saying, listen, a lower unemployment rate isn't bad. Solid growth isn't bad. These are things that the market is going to take a cue from. So we really do need those things to kind of unravel a little. Now, that's outside of anything untoward that comes from yen carry trades, things like that, structural things that, we don't, maybe they're known unknowns, maybe there's some unknown unknowns out there, which I love those expressions. Who came up with those? Was that Cheney? I think it might have been Cheney who came up with the known unknown.
I don't know,
anyway.
but before you get there, real quick, I'm going to just quickly show you something that Alexander sent me, because he does keep me in the loop on health scares. That's the kind of unknown that we worry about. War vibes can turn into something more. Health scares can turn into something more. The point is, we have to trade what's in front of us, and we cannot trade based on fear. We can't live in fear either. But we do have to be a little aware that we're in a backdrop now of not only major changes in administration policy, and policies dictate price, but we also have, which by the way, can also trigger a growth scare, which is what I'm focused on. But we also have war and health scares.
So yeah, I mean, I agree with you. And what I always try to think of is I'm all for volatile environments and recognizing that, but I always try to think of, well, what's going to be the next climb the wall of worry environment? That's the sort of the climb the wall of worries can be frustrating, because everyone's going, well, I don't understand. How can this be happening? There's all this bad news out there. What do you mean we're up every day or most of the time? And so I always kind of think of that. And sometimes you just kind of have to look ahead a few weeks and go, well, I don't see a lot on the horizon. So I like your idea that we may actually end up, I don't know if that bottom gap gets filled right away. If it does, I think I might be a little bit of a buy on the dip kind of guy in that sort of scenario, but because I think we do kind of drift up into the 6,000s again. And so when we talked about this Monday, we said, well, what are we going to talk, what can we talk about and what should we call it? And I thought, and my idea was, second chance at the Trump bump. And of course that sort of passed a little bit, because we had the second Trump bump here. And so that's when I started looking at things on Monday and Tuesday, sort of thinking, well, where are the areas, financials, for example. And so I got involved in Goldman Sachs, which had a really nice bump today, because I think you have to kind of really think of, don't think of picking the bottom in crappy areas, crappy stocks that just, are having reflexive dead cat bounces. Think of the things that are, that are already kind of acting relatively well on a relative performance basis. And for me, that's kind of things like a Goldman. Meta is sort of off the table for me right now, because there's this TikTok thing. There's some things going on.
Oh my God.
Yeah, that's a little bit of a mess.
It was such a nice chase short the other day. Just one headline, and TikTok's gonna, come down on Sunday, and then that Trump's gonna, get it back up, and hands of Musk and the whole thing. But this absolute wave of headline risk is too much. I'm out.
But that's how fickle it can be, right? That was a great example. As soon as that meta happened, the market wasn't far behind, and in that sort of cat in the room full of rocking chairs environment, then you can get those big moves suddenly and very violently. So I think the market's going to appreciate if we can indeed start to fill some of those gaps to the upside, which I think we're going to do. That felt very strong to me today. Now, one of the things we definitely want to make sure that I think the rally has to be somewhat, I think that the rally hasn't been very broad, or the performance from markets hasn't been very broad, again, because of this worry, the high rate environment. We're sort of back to the future or whatever, back to where we were when it was just about 8 or 10 stocks and the rest of the market kind of sucking wind. Well, now maybe we have a shot at getting a little bit of broadening out. And I saw Home Depot do well today. Saw some sort of stocks like that kind of act a little bit better. Although we definitely saw some movement. We saw Meta bounce. We saw Tesla bounce, although that might be inauguration. That might be a bit of an inauguration.
Hans, we had 91.73% of the market advance. It all looks great today, but
It does, yeah.
but I
Yeah.
contend textbook. I've seen this before over many years. We will have a 90% down day in the next week. Now I don't know how Monday's going to figure in because it's a holiday, but that's all I'm saying is we'll get to test these new bulls. I still think it's a bounce, not a rally. I still think we're going to go and tag that lower level before we go higher. But for right now, we're just sandwiched in between. Basically, 57, what was it? The election, 57.83. We've got to get above 59.83 and then get back above 60. You think we're going to go right there? I'm not convinced.
I think that's okay. All right. I like that.
I'm not
I like
confirmed.
that.
Here's the deal. I'm not confirmed. Like I just did this intermarket analysis, right? This weekend, and I posted it on Monday. All right, into inauguration. So we really don't have anything. I got to wait until this stabilizes and then starts to move higher. Long story short, I need confirmation. That's it.
And look, I think, I think at least from my perspective, yesterday I did a little video and I said, look, these charts have some damage on them. So today helped, but it doesn't entirely fix things. And from the dealer's perspective that we talk about, we're still sort of in an iffy area. And we look at, you and I have talked about the VIX beta to the S&P, still very, very high, 98th percentile of VIX futures to the S&P selling off. So it's very reactive still, very nervous. VIX dealer gamma imbalance. So there's gamma exists in all things, not just index and stocks, but in the VIX world. And you can see that VIX dealers are very short exposure in upside in VIX. So that makes them very nervous. So that probably keeps us in a world where there is some nervousness out there that could start to unravel. It wouldn't take a whole lot. And if we look at VIX ETNs, right, the leveraged ETNs, you can see that we're 82nd percentile in AUM. And so we often talk about sort of listed gamma where, option positions, open interest, whatever's going on in listed markets. But there's this whole synthetic gamma world of levered ETNs and ETFs and inverse ones that contributes as well to sort of selling into sell-offs and buying into rallies. So it exacerbates the moves that we're starting to get used to. Now, I want to play a little game of good thing, bad, positive, and negative. So here we can see that the reaction of the VIX to the S&P sell-offs has been more muted as we've gone along since August 5th. So we can see these lower highs, and all this is saying is that the VIX is getting less nervous. It's less and less the cat in the room full of rocking chairs. And today probably brought us down into here, right? So we're probably down into to this sort of area here. What I wouldn't want to see is a VIX very reactive again that gets us above this trend line. And I think you can draw trend lines of practically anything.
Oh, yeah.
And then one positive thing I would say is that the vol control funds, so these are funds that buy when volatility drops and they have to sell when volatility is rising. This is yet another of these kind of strange things happening out there that have an effect on markets. And we can see they were sort of all in December. We were really bulled up, weren't we? Kind of in November, December after Trump, really bulled up. And I guess that just had to unwind. So they were all in, and now they're back down to about the 40th percentile of allocation, which is fairly low. Unless you get into a real bear market, then you get down into here. But generally speaking, for a relatively healthy market, we have some of these futures trading, systematic trading sort of funds that have now de-risked. So I think what that means, and the shorts and the hedge funds are shorting. So I think what that means is you have there's been a bit of a washout, a little bit too much negativity that has to work its way, that has to unwind a little bit. And maybe that's where we are at this point, where it needs a little bit of time to unwind, but remains to be seen which gaps we are going to fill at this point, for sure.
Yeah, I don't know how negative the market is when we're only like 3% from all-time highs, but we definitely have been a choppy, sloppy mess. Let me just share this chart and get your reaction, which is the seasonality of VIX. This obviously is going around, so it is not a timing tool per se, but it is guardrails, which means precedence, right? History rhymes and all that jazz, is it's going to bottom pretty soon. And then typically we have a rising VIX market, some weakness January through March, Ides of March type of thing. And it's never exact like the Santa rally, you know, it has just a high possibility or probability of repeating. Any thought? And then of course, July bottom, and then we have kind of the September into October volatility. That has been very consistent. So what are your thoughts on the seasonality of VIX?
Consistent, very, very consistent. And I wouldn't be surprised if that repeats. Now, a sort of slight increase in the VIX may not come with a sort of corresponding crash of any kind, but I do believe that probably will hold that seasonality. And then there was another one that actually you pointed out as well today, which I wanted to show as well, which was, let me grab this. I wanted to show the seasonality. Remember you showed me that chart on seasonality and volatility as it pertains to earnings. So let's take a look here. We've got typically, if you average out earnings seasons, so we've got a number of them per year. If you average them out, we see that starting at the beginning, we tend to see a drop in volatility for a couple of weeks, and then it starts to edge up a little bit over the next few weeks. January tends to be a little bit different. We get a little bit of a pullback in volatility off those first few reports, and then we start to pick up. And so maybe this is part and parcel of what you're showing, Samantha, which is really just kind of a general rise in the VIX, rise in nervousness into the first few months of the year, which, to be honest, tend to be okay months though, right? They tend to be okay. Last year we did okay until about March, April. We had a little dipsy doodle in there, but it's obviously
that was also macro.
That was macro as well, but it also depends on the results, right? We're going to be watching big tech very carefully. So
you know me, I'm much more focused on, unless the option flow is bullish, we need a macro trigger to interrupt it. Whenever we get a macro trigger to interrupt it, then the market succumbs to weakness. Breadth breaks down underneath the surface. Since December 2nd, it creates an air pocket of risk. And so we had that 3% down day on, I think it was December 18th, right, with SPX, which doesn't happen very often. So, and then we had the green shoots on December 20th, which was that Friday. We always kind of run with these option, they end at the week or the month or the quarter. So anyway, long story short, that was the bottom for December. And now we have just been chopping violently. We filled finally, after 2 months of big picture going sideways and big wide swaths, we fill the election gap. Now, the power of this bounce that we've had Monday, calm Tuesday, strong Wednesday on the 5 reasons that I've outlined, mostly has to do with falling dollar in yields, not CPI, not even the algos. A lot of the hedge puts that were added yesterday that had to unwind, no question. Structurally speaking, we've talked about this, right? Tail on the dog. No, it is the dog. So flea on the tail of the dog. It is now options is the dog. But it is really because we had that big bounce in bonds and yen, which caused dollar and yields to soften and give that whoosh, short covering reason to cover. So I just think we're still going to have to focus on the macro for the absolute timing of these ins and outs, whether it's daily or weekly or monthly. And right now, we're waiting to see what will policies really dictate from the administration, the new administration, especially Trump tariffs and tax cuts and Treasury. But earnings typically doesn't move the market. It might move a stock, which moves a sector, but we don't really have a directional move in the market one way or the other during an earnings season. It pretty much just hangs in there, right? That volatility, I don't even know what you want to call it, clench. And then once we're free of earnings, then we have a directional move of size. That's what I have anyway noticed just from a pattern standpoint.
We're in that. That's funny. We're in the clenching. We're still in the there was a little bit of unclenching going on today, but we're going to be in the clench for earnings season. And of course, volatility will rise into earnings season because that's what option pricing does. It gets a little nervous into those events.
Well, the realized fall that you showed from that spot gamma chart, absolutely. So I didn't want to interrupt you, but I just keep going. For me, it's a macro trigger that interrupts the option bullish bent.
Yeah. And that's where I think it's important for people to understand, because we often, as option traders, we sort of look at, well, where's the realized vol? Where's the implied volatility? So if implied is higher than realized, meaning if option pricing, if if the cost of insurance is much, much higher than the underlying risk, then we call that a positive carry. We call that a positive volatility risk premium. And in theory, you should be able to capture that by selling volatility, by selling options. And that's what we're really trying to do as option sellers. If that's your jam, is you're trying to really capture that vol risk premium over time. Now, the problem with that game is it seems easier than it is. You have the strike risk. And so for me, direction of volatility is very, very important. So I tell people, so I started adding a little bit of risk today. I wasn't really adding it at 5,800. And so somebody might say, well, Hans, what are you doing? You could have bought the market lower. And I say, well, it's about recognizing where there is more risk. So if we're, down around 5,800, we're in a very potentially volatile powder keg kind of environment where if we start to push down 150 points, we could be in real trouble. So I'm very much of the opinion.
That is a very important caveat. So as you were talking about this inflection point, okay, sure, we can have a nice Vanna rally, right? This nice bounce off the election gap fill. But we can also revisit it and take it out to the downside and head back down to 56, 70 area, which is a risk. So, this is basically why we're looking in at shorter time frames, but we definitely had dollar and yield moving very strongly with energy pricing, which is going to, by the way, be a headwind for earnings next quarter. Long story short, there was reason to be cautious. There was reason to make sure it is safe. And honestly, this 90% up day is not a surprise to me. It won't be a surprise when we have a 90% down day in the next week, and then we retest. And then we'll see if the bulls are really brave enough to come in and bid it up, like you just said, right? That 5,800, whatever level, 5,850. And we'll see if they really, really want to take it higher then.
Well, that's why, why having guidance and from people, not that we've just done this a long time.
The best we can with what we got.
Right. We do what we do well, right? Don't ask me to fix the bathtub because it's not working. That's not my thing. But ask me about volatility, ask me about markets. I can probably help you out a little bit there. And that's what I try to impart on students and members. I say, listen, volatility of direction is important, right? And having that knowledge sort of makes you realize that having just that little bit of extra patience, and that's the way you look at things. I know. I really love how you do that. You say, listen, I'm not, this is already acting well. And you're going to get clients jumping in going, the first day up, I'm getting into this thing. You're saying, well, listen, I feel better about it once it gets to a certain level, then it could really have a move. So being a better trader and maybe even investor is getting in when you have as many tailwinds behind you as possible. And that's why I tell people in that kind of environment, that short gamma environment, 5,800, 5,750, around there, you don't have those tailwinds behind you. Things can change in an instant. I'd rather get more constructive on the market once it starts to sort of get to certain levels that make me feel that I can get a little bit more constructive on things. So just having that little extra bit of patience. And one thing I often tell people, it's very important to understand the direction of volatility. So when I'm looking at getting into, say, if I'm looking to sell options, for example, I don't want to sell options when realized volatility is pointing straight up. That's like saying, okay, there's a storm coming. Let's start selling a whole bunch of house insurance because, boy, that storm, I'm sure hopeful that it goes by us. No, you want to wait and see how it develops. Is it going to go over you, to the left, to the right? Is it going to smack you right in the face? You don't know what's going to happen. So when you have indications that things are getting worse, it's time to kind of sit on your hands, because that's where that's one of my favorite positions, is sitting on my hands and just going, okay, let's see how things.
Right setup.
Yeah, wait for the right setup, because guess what happens if you just keep catching falling knives left, right, and center? When the true opportunities come, you're out of powder, right? You're out of dry powder. You're sitting there going, please God, I won't ever do it again. And you're praying, saying, if you could just let me out of this jam. Meanwhile, other people who had that patience are able to wait for the right opportunity. So I think it's even more important in a way for option traders, because you just have to be a little bit more. You have an eroding asset, right? And if you're short selling options, you're short leverage. So you have the downside of getting things wrong is much worse than if you're just looking at kind of a
Yes,
linear relationship.
And in full disclosure, I don't want folks to just go take a bull risk reversal in TLT, because the ability to defend it must be there. It is doubly explosive if wrong. So that's why we do this, right? We're kind of talking about everyone has a different time frame, how they define it, and risk tolerance and experience set. But anyway, that's the kind of psychology of trading that you're talking about. I have a comment in the webinar chat, which is very funny. Fix the bathtub must be a Canadian problem. Also have a question from PQ, and she's a member. So she asks, when would one benefit more using RSP instead of SPX for options in both protection and upside? And I think one of the reasons I don't know, I want to show this chart, Hans, real quick. Now, RSP is that equal weighted thing that no one talks about or trades, but she's coming up with a really good point. And institutions do use it, like the small cap 600, they prefer over the small cap 2000. The 2000 has lots of riffraff, 50% unprofitable, whatever it is, whatever the rate is. But the small cap 600 has the best of the 2000 that have gotten pushed into that particular index. So it's quote unquote safer. Now she's talking about RSP, and I happen to be showing, let me do this. I'm showing a chart, which is a ratio. This is my weird little thing. You know how I do growth value ratios? Well, I do this RSP to SPY ratio. And way the heck up here is our concentration risk. This is SPX, heavily weighted. Repeat, heavily weighted in Mag 7. And I can show you exactly what the weightings are, because I was working on a weightings readjustment for my Mag 7 ratio. I also have a Mag 7 ratio. Anyway, this is RSP, equal weighted relative to SPX on the ground. We're talking COVID lows. I'm talking 2020 COVID lows. Can you see over here? April, March, April. Here we were in July. And by the way, what happened in July? Yen carry trade unwind, concentration risk unwind. In 1 month, we had Nvidia fall 35%, SMH 25%, and NDX down 15% in 1 month. That's why I study this. Now look at this. We got a big old double bottom. Maybe it's a pattern that means something. Obviously, this is on a bigger picture. But she's asking, and this is why, that might be opportunity, right? What if we do have disappointment in earnings, Hans, with these Mag 7 plays? Not that it's expected. The bar has been lowered. We don't have the headwinds of higher dollar and higher yields and higher oil for Q4 results. We will have them for Q1 results. But the point is this: what if they disappoint now or next quarter? Boom, concentration risk comes down, RSP relatively goes up. Makes sense, right? We haven't even made it back into I don't even know what this is. This is the COVID lows. This is the concentration that took all of 2020 to digest before we had that explosion higher relatively in both growth and value. Anyway, long story short, how would you deal with the options play of RSP? I love
that. Yeah, I love that play. I think that's a great chart. That's gold right there, because I think we probably are right for a little bit of outperformance. We've seen last few months of rushing into the balance sheet heroes again, and I think that's an area where you can just kind of, I don't think the volatility is very expensive. Let's see here. We've got relatively flat upside skew, so you can probably play something like this with just, I don't know. You could, if you wanted to be a little bit more careful, you could add a call spread, something like that, just to kind of spread out your risk and create a little bit of upside. So you might go in here and say, you know what, I think we're going to have a sustained rally in something like this. You might go out to March and take a look at, I don't know how the options are in the RSP.
They're terrible.
To be honest.
They're
terrible, eh? Yeah.
No,
so then.
Oh, no, they're not good. Even though there's tons of them, they're extremely wide and on aftermarket. So it's not showing up the way I want it to right now, but
I wouldn't, if it really is that illiquid, look at that sell-off there. Wow. So, this is somewhere where I might pick up some in the money calls. If you can kind of source a little bit of liquidity in there with wide spreads, I always say, listen, kind of test the market. Don't just go ahead and throw in a market order. If the market is $4 to $4.75, get in there, bid 4.25, bid 4.35, keep moving your bid up little by little every minute or two, and see where you can get filled. But I like it. I like that outperformance idea. if you truly believe that rates are probably, I think that could be the interesting swan of the year. I put that comment out. I said, you know what? I love it when we get these extremes and narratives. And right now it's, oh my gosh, they're going to hike rates. The inflation's out of control. I don't think it's going to be out of control. You often talk about, China exporting deflation, and the rest of the world's not doing that great. And I think technology comes to the rescue as well.
I don't think China's doing badly at all. So
yeah,
they're not related. We're just the market, obviously, where money flows, dollar, of course, yield harvesting, all of that. But rotation hasn't moved into the China ADRs. But as it relates to their inflation, deflation, that's totally separate from their stock market. And right now, we're still waiting for stimulus to kind of pick up and bring them over the wall, meaning the China stocks. But the inflation deflation is very much nuanced and it's more than just China. This is
but
not
inflation,
all the time.
inflation has been an ugly word for years now. So we've been sort of, it's become part of our every waking moment from an investor standpoint since 8 or 9% inflation. So it's very much a topic, but it really isn't out of control. And I don't think it gets out of control. And I think markets can very much absorb a reasonable amount of inflation and still do well, as long as growth is there, as long as employment is looking good. I think markets are eventually they're not gonna mind something like that. So I think that the potential big melt up swan could be that at some point we really do get a little bit of a drop in inflation and everyone goes, oh my goodness, the rate cuts are back on the table, and which is really what they want. And that's where stocks can really maybe go for another leg higher. Nvidia, I wanted to show people an Nvidia position. So I got in a little bit early on this trade. We started to have this breakout. You remember a couple of weeks ago or 10 days ago, Samantha, we had this big breakout above 150, and it pulled back a little bit that day, maybe around 148. I put on one of these financed spreads. I sold an April 130 put to buy an upside call spread, which was, I think, a 160, 180 call spread. So one of these finance plays that I really like, one of the reasons I like them is you get to sell that downside skew. So you get kind of steeper skew on the put side, generally speaking, not in things like MSTR and gold, but in your typical stocks. And so you can kind of take advantage of selling some of that expensive downside and use that to buy some less expensive upside. And the upside has not been very expensive. So I think one of the interesting opportunities for people is something we talked about even a couple months ago, which is people forgetting about the right tail. And upside isn't that expensive right now in many areas. Now, what happened was I got in early and the timing wasn't great on it because everything just completely reversed. But what happened when it got down into this area here around this trend line, and an area where I think Nvidia starts to get compelling again, I bought back. One nice thing about the risk reversal is that you have a little piece that you can always play with. So I bought back the upper short call for a couple dollars, which I'd sold for several dollars higher. And so now basically what I've got is this short put and this long call. So now I kind of have this unlimited upside. If we ultimately start to move up, we have that unlimited upside in that position as well. So I always like positions where I have a few legs in there. And we talked about 1 month ago, I remember it was on MSTR where I took off one leg and then I had this I had this free downside put spread. So I like these multi-leg strategies sometimes because even if you're wrong, you have something to do even as things are going wrong that can cut down on the cost of the core strategy. So now I'm positioned basically long Nvidia again with long exposure. So I kind of like that. And then in Hood, this is one of my favorite names. I think it just continues to go higher this year. I think it's got all the right things happening. Is it cheap? No, but it's this sort of FinTech area that I think has a lot of potential. They have a lot of potential to grab market share from wealth management, from other areas. They're into crypto, all that stuff. So I had a risk reversal in here. It's already doing well, but I'm adding to that. And so I try to teach students, I say, you know what, don't add to bad positions, add to good positions. So don't guarantee it's going to work out. But when you
Speaking
find
of
something that's
which,
really worked,
I was saying, speaking of which, adding to good positions. So Nvidia, that financed call spread that we talked about a few weeks ago, that went very quickly to that 152, 153 all-time high, and that finance call spread that I had presented to clients on December 20th was March, right? Selling the 115 and then buying the 136 by 150. That went right. So it was like up 5,800% within a few weeks, but that's not usual and customary. I was expecting this to be a run into earnings, which is in, later part of February. And now they've announced they're doing a quantum event March 20th. So that, by the way, came all the way back down now I took 50% off. I mentioned this as well. And when it came back down, I'm like, this looks good again because it had dropped from 153 back down to my level, which was 129.80. That same trade again, it's still good. It hasn't broken that 130. It really loves the 136, if truth be told. It's been jig-jagging all over the place. And they now have announced not just earnings, but they've also announced the March 20th quantum event. This puppy is still going to get defended as long as the market is not careening lower. Nvidia will still be defended until the end, until they actually disappoint. It could be this coming February, but not very likely since they just scheduled a March 20th quantum conference. So I'm gonna go with Q2. So I think it's still bullish in for Q1. And so any
level is 129.80. That was your level, Samantha? 129.80. I think you.
Absolutely.
Yeah, you nailed it within.
I know. No. Everybody knows 129.80.
129.80. So
Let's round up and say 130. But I'm really.
You missed the low. You missed the low by 17 cents. So I hope you realize
Whatever.
that. Yeah.
But this is my thing, right? So if I get something, I glom onto something, right? Like we're gonna have a little bond yen bounce, and that's gonna help yields and dollars soften, and we're gonna have this bounce. But I don't think it's gonna last more than 2 days, right? So I think we're gonna de-risk it at the weekend, and then who the heck knows about inauguration? But we get this back and forth, you and I, and what you're trading long with MSTR and Hood makes sense because NASDAQ is still supported, Nvidia is still supported, Bitcoin and Ethereum are still correcting sideways in time, not price. They're not dumping. So people have to zoom out and look on a day, on a week time frame. But in other words, nothing is falling apart. We got up to some risk levels with dollar and yields, and it's definitely going to be, I think, very eventful in Q2. And I'm really not bullish at the end of the year. But for right now, we still make hay while the sun shines, and that's what we're at. Monitoring VIX, by the way, this is a question in chat. I want to share my chart real quick before we kind of wind down and close, which is this VIX ratio that I have for clients, because you're asking about do you benefit from monitoring VIX for ES and SPY? I use a VIX ratio, which is the 3-month to spot, and this 120 this is my pattern recognition. But anyway, this is my ratio. And so I do have this, it's on a daily. I'm sure you could drill in and look at it more closely. But for example, it creates patterns. And so when this was a head and shoulders pattern, I said, be careful, because all we need to do is break below this 120 and we're going to have a big SPY pullback. And then that was the day right here, we had that negative 3%. So I happened to present that chart in advance because it was a pattern of weakness, right? And so, of course, once we got back down to the August 5th low, it means we should stabilize here. So anyway, yes, I do use VIX every single day. I look at it. The actual underlying VIX, I have a line in the sand, which is 1929 that I share with clients as well. Just as an example, I'll show you. And it's not very hard. If we're above 1929, the market is bearish. And if we're below, the market is bullish. And it's really that simple. It's that simple. So yes, I can do some, funky things with VIX in, pattern recognition and candlestick and technical analysis, just like everything else. But ultimately, on an intraday basis, which I think is what you're asking about, put that 1929 on your chart and see how VIX reacts to it. It's fascinating.
The last point I would make on the VIX side of things is I think it still remains an interesting, very reactive kind of hedge. Now I have some Fed puts. I should have sold whatever it was a couple of days ago when the VIX hit 22. But for me, it was just a little piece that was making up for some of the pain I was feeling in a couple other positions. But so I don't mind seeing that disappear. But that was a nice opportunity there to make some quick money on that vol pop. I would start to look at some Marches as well. So I don't think March futures are necessarily going to drop too far. So that's where we can start putting on some interesting trades again, maybe selling some March 15 puts to buy some upside calls. If you still think we are going to have this kind of uncertain market that, with infused with a few big sell-offs or a few reasonable sell-offs, you might have a little. Yeah, so that could happen. So you could get in there and sell. You're not getting very much for the 15 puts in March, but you could sell those to buy. Because remember, even though VIX is trading at 16, the March future is trading higher, right? These March options don't trade off the VIX cash, which is the one we see on TV all the time. It trades off the VIX futures, the March futures. So it's a little bit of a different animal because there's a different future for every single expiry, even weeklies, which barely trade, but there's a different underlying. Whereas when you trade Apple options, well, it's Apple is the underlying for every single month that you trade. So that's one thing to keep in mind, is that there's sort of extra little bits and pieces of nuance to trading something like this. So if you haven't traded VIX, don't just jump right into it. But I think it could still remain an interesting place where you get that beta to an S&P sell-off, as long as we continue to see that sort of 95th to 99th percentile in terms of reactiveness, I think it's an interesting place to have a little bit of a hedge in there.
And I see a question on my Mag 7 weighted ratio. I don't know if you're a member, but hit me up in DM because I do have to manually adjust that. Happy to share that ratio, by the way. You can create it for yourself in TradingView. By the way, he's talking about this.
Marshall said it was Donald Rumsfeld. So it was Rumsfeld who came up with the known unknowns and unknown knowns. So thank you. I forgot about that. I threw out Cheney's name there, but.
So here's the ratio. And yes, to answer your question, I have to manually change it. Anyway, hit me up for that. Happy to share it. And you know what? I probably should update it because weightings do change, but it has worked so well from this inverse head and shoulders, right from the January 2023 bottom, right into the the July through August, right into November 1st, 2023. Remember November 1st, you hear this all the time from me. Fed pause, Yellen Yahtzee, boom. And then of course we had some pullback, which was, you were just talking about April. That was a macro event. I was talking about the yen carry trade unwind into the August 5th low. That was a convexity rally of size. Here was a fib level. I was expecting this to kind of digest a little bit. We got a little bit of a fake breakout. Now, it's not quite a fast failure, but it is a reversion to the mean potential. So when I say we just had a 90% up day, 2 thumbs up. We will have a 90% down day at some point in the near future. We could break this level and head back down to the trend line from an Apple earnings, from a whatever earning, Mag 7 tech earnings. Nvidia is not until I thought it was the 19th, but it's actually the 29th. Anyway, the point is it's 22nd. It's actually further out. So we're going to have an ability to size this up. But yes, it is based on weighting. And I have to manually adjust it. That was a long answer. Sorry. Okay, I think we hit everybody else, though, in the list. And that's it. We'll come back here and do this again on Wednesday of next week after the close. We will have a little bit more from the Trump inauguration, but more importantly, smooth transfer of power, fingers and toes crossed, and then a release the Kraken. In other words, all these policies that have been talked about on the campaign trail and tweeted. Oh my God, we're going to have 4 years of on again, off again headlines. Like tariffs are going to be rolled out slowly. Tariffs are going to be dumped.
Guns a-blazing. Trump's going to come in guns a-blazing. It's going to be exciting. You
know what? I agree with you. I think he is going to come in guns a-blazing. But is it a scary or just we're gonna fix things and anyway. We'll find out. We'll talk about it next Wednesday. Join us again. Thank you so much. Hans, any other last comments?
That's it, Samantha. Thank you. I'm going to see the Raptors take on your Boston Celtics tonight, and I don't like our chances, but we're going to try our best. It's going to be fun.
I'll watch it with you on the Boston side. Everyone, thank you so much for joining us. Macro to Micro.
Thanks, everyone.
Power Hour. You can find us on Twitter. You can also go to LaDucTrading.com/Hans. You'll find them. Okay. Cheers, everyone. Bye.
See you guys.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.